A huge inflow of cash is going into the stock market. A year-end melt-up is coming, according to Goldman Sachs. I've got all of that information and more. Let's begin. Taking a look at this article here, you can see some of these charts and the data which they have presented. I will bring you just a couple quick points, the ones you need to know. The January inflow wall of money is the most important dynamic that I'm tracking in the market right now. January, typically 134% of the yearly flows. This is just getting into all the different dynamics that are available to you to understand. But of course, all we need to know is, I'm going to read you a whole bunch of stuff. All you need to know is there's a lot of cash ready and waiting to move out of other assets and into equities. But we don't know what's going to happen here in the future. What we have to understand is, quite frankly, that with the taper being expected, the course of taper, as well as interest rates being down the road, we are still risk on. And that means equities are going to be something attractive to investors. Now, which stocks precisely and which sectors and so on, that's debatable. But risk is definitely still on the table. Looking at this here, 2021 has averaged roughly doubled the 25-year average, or $125 billion. Core thesis is that money will come out of negative real yielding cash out of bonds aggressively and early in 2022 following December boardroom asset allocation meetings, more cash out of the stuff that doesn't get any returns and into equities. And you can see that just split up over here on these two charts. 22 basis points of new cash, as well as 134%. More inflows in January than the other 11 months of the year combined. A lot of money in January. Okay, that's all you're seeing there. The 10 largest global equity inflows ever. That's right now the largest year-to-date global equity inflows by year since 2001. It's 2021, 2.5 times. 2.5 times the amount of money that they are spending. And they're spending on everything today. More money is available than ever before. And why? Because the debt is cheap. S&P 500 seasonality, December and January. It just gives you an idea of what has happened. There's going to be more money coming through, okay? And that's just the way it is. The Santa Claus rally, but even before that, you technically have from Halloween and on. Historically is positive. December being particularly positive. What happens here? You can see top New Year's resolutions for 2020. Number one being manage finances better. Now, what happens in February and beyond may be a different story, but at least for January, this is what people tend to do. They get their resolutions and then they kind of fade off on that. Global fund flows, take a look. Equities seeing a generous rise. And I do believe that as we continue on with these policies here, there's going to be more and more interest with equities. It's just a simple matter of fact. You could see though, when you look at bonds, they're still, despite their negative yield, in many cases, they are still attractive because it's guaranteed. Okay, if you invest in a German bond and it's returning, let's just say 0%, you're going to get your return back at the end of that. And that's the world that we live in today. Oh, I'm going to get something back. I'm going to be able to hold on to my capital. Yes, inflation is eating away at it, but at least I'm getting it back. January S&P performance is very strong following a year of very strong gains. Since 1928, there have been 14 instances where the S&P 500 is up greater than 25% or more through November. Huge, right? 2021 may be the 15th. So there's still potentially more to go. Apple pulls the longest rally since July as tech broadly falls. Apple, right? Doing well. You could see this. I had a few things prepared in here, taking a look at the S&P 500, but the breadth not necessarily so good. The number of members greater than the 200-day moving average has fallen. So a couple of these companies are doing really well, Apple potentially being one of those. But what's it all about? $1 trillion to stocks in 2021. Look at the surge, the absolute surge of cash flowing into the markets. And who provides that? As always, the EPFR. This is the official data. This is what's going on today. More and more cash flowing in. And when's it going to stop? Well, of course, there is one factor, and that is interest rates, and that is tightening on all different levels. There's a lot of different things, but the two most important, of course, being that Fed funds rate you got to watch, and their balance sheet, the purchases that they make. These are two big factors. But if for some reason there's a big slowdown, a recession, a depression, lockdowns, major lockdowns, that puts a big dent in this. Growth could diminish rapidly. And you saw what happened in 2020. Are we heading that direction? I have no idea. Some areas are locking down. Some places suggest that there is a recession happening today. But at this time, if you assume that's not going to happen, then stocks can continue to see more cash flowing in. Until then, though, apparently it's party on, Wayne. Look, if you want to support the channel, just hit that thumbs up button if you appreciate the information and you want to notify everybody out there in YouTube land that this is a good video. Just click that thumbs up, click the like button. It's right down there, and I do appreciate that very much. I'll see you on the next one. Take care.